Hey everyone, welcome back to Corporate Decoder. Today, Kimbell Royalty Partners LP KRP just filed its quarterly report, and I am seeing some very interesting moves in their oil and gas holdings. Quick note, this is not financial advice, just my take on public filings for educational purposes. Their latest report shows a significant acquisition that could reshape their future, alongside strong revenue growth, driven by higher commodity prices. Let us dive straight into the financials. As of the 30th of June 2026, Kimbell Royalty Partners reported total assets of about $1.3 billion. This is a noticeable jump from roughly $1.2 billion at the end of 2025. The biggest chunk of these assets, over $1 billion, is in their oil and natural gas properties. This is where we see a big increase, going from about $1.1 billion at the end of last year to over $1.2 billion. Now, this surge is largely due to their acquisitions. Specifically, in June 2026, they completed the Mesa Acquisition, valued at around $146 million. This deal added new mineral and royalty interests, mostly in Texas and New Mexico, boosting their property value. They funded part of this with cash and issued new units, which is a common way companies expand. On the other side of the balance sheet, total liabilities, mezzanine equity, and unit holders' equity also increased, reaching about $1.3 billion by June 2026. Their long-term debt went up to nearly $479 million from about $441 million at the end of 2025. This increase is tied to funding these acquisitions and other operational needs. Now let us look at how they are doing financially. For the 3 months ending the 30th of June 2026, their oil, natural gas and NGL revenues were $103 million. That is a big jump from $74.7 million in the same period last year. This growth seems to be driven by higher prices. They received an average of about $97.85 per barrel for oil in the second quarter of 2026 compared to just $63.52 a year earlier. Natural gas prices, however, saw a slight dip. Looking at the first half of the year, the trend continues. Revenues for the first 6 months of 2026 were $185.9 million, up from $164.6 million in the first half of 2025. This is thanks to a strong increase in oil prices, up about $17.76 per barrel compared to the prior year period. They also reported a gain on commodity derivative instruments of $6.1 million for the second quarter, which is good news compared to a smaller gain last year. This indicates they are managing price volatility effectively. With higher revenues comes higher taxes. Production and ad valorem taxes increased to $8.2 million for the quarter from $5.7 million last year, which makes sense given the higher commodity prices. Depreciation and depletion expense remained relatively stable, around $30.2 million for the quarter. This is the cost of using up their natural resources. All this led to a solid operating income of $59.7 million for the quarter, a significant increase from $37.8 million in the same period of 2025, and their net income for the quarter was $47.3 million, a substantial rise from $26.7 million last year. This translates to 40 cents per basic common unit for the quarter, up from just 2 cents a year ago. That is a massive improvement and likely why we are seeing positive headlines about their distribution hike and growth acceleration. For the first 6 months of 2026, net income was $54.2 million, slightly up from $52.5 million in the same period of 2025. Earnings per unit for the half year stood at 45 cents compared to 22 cents in 2025. Looking at cash flows, net cash provided by operating activities for the first 6 months of 2026 was $117.7 million. This is a slight decrease from $126.5 million in 2025, but still very strong. Their investing activities show significant spending. For the first half of 2026, they used $44.4 million in investing activities, mainly for the Mesa acquisition. This is much less than the $223.3 million used in the first half of 2025, which was dominated by the Boren acquisition. Financing activities show a shift. In the first half of 2026, they used $72.4 million, largely for distributions to unit holders and repaying debt. This is a change from the first half of 2025, where they received $97.2 million, mostly from issuing new equity and taking on more debt. It is worth noting that in January 2025, they completed a significant equity offering, raising about $163.6 million. This capital was used to help fund the Boren acquisition. They also have a common unit repurchase program authorized to buy back up to $100 million in units. This shows a commitment to returning value to shareholders. Looking ahead, a significant event is the announced drop-down transaction on the 16th of July 2026. This involves acquiring more mineral and royalty interests for about $75 million in cash plus issuing new units. This acquisition is expected to close around August 2026. Also, in July 2026, they converted some Class B units into common units, which is part of their ongoing unit structure management. Regarding risks, the company notes the impact of global conflicts and market uncertainties. While they have not seen material adverse effects yet, this is a significant factor to watch, especially given the oil and gas industry's sensitivity to geopolitical events. They also mention potential impacts from changes in US regulations and tariffs. This highlights the complex political and economic landscape that can affect their business. The report clearly shows the impact of commodity prices. Oil prices have been very volatile, with highs reaching over $114 per barrel in the first half of 2026, while natural gas prices fluctuated significantly too, reaching highs of over $30 per millimeter BTU in the same period. The rig count, a measure of drilling activity, increased to 561 in June 2026, up from 533 a year earlier. This suggests increased exploration and development activity, which is good for Kimbell royalty partners as it often leads to more production on their leased lands. They also provide non-GAAP measures like adjusted EBITDA. For the second quarter of 2026, their adjusted EBITDA was about $84.9 million, and cash available for distribution was $59.9 million. These are key metrics for understanding their ability to pay distributions. Overall, Kimbell Royalty Partners appears to be in a strong position. Their revenues have significantly increased, driven by higher oil prices. They are actively growing their asset base through acquisitions like the Mesa deal and have a clear strategy for capital allocation, including debt repayment and a unit repurchase program. The reported earnings per unit are also very encouraging. The main risk I see is the continued volatility in commodity prices and the broader geopolitical uncertainties that could impact their operations. However, their recent performance and strategic acquisitions suggest they are navigating these challenges effectively. The increased distribution and strong revenue growth are definitely positive signs. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.